Good afternoon, ladies and gentlemen. My name is Michalis. I'm one of the market analysts here at HF Markets, and I'd like to welcome everybody to another webinar. Today, we're going to be looking at live analysis. So, once a week, when there's a main event, something which we believe is going to create, not necessarily we believe, but something we know traditionally creates a lot of volatility within the market. A lot of the time, new signals and indications materialize. What we do is we have a live analysis session. So the great thing about these live analysis sessions is that, of course, yes, we're going to spend a couple of minutes looking at a very quick presentation. We're going to look at what was announced by the Bank of Japan in terms of their interest rates, in terms of their monetary policy, in terms of course, their forward guidance, which is, of course, the most important thing because that creates the most volatility within the market. But what we're going to do is we're going to look at exactly how this creates volatility within the market, what type of volatility, what this means for the Japanese yen, and look at potentially areas of the market where we can actually take advantage of this price movement. So, yes, we're going to spend a couple of moments looking at a presentation, but very quickly we're going to go to the live chart and look at what's influencing currencies, what's influencing indices, look at new signals, new indications which are being triggered by the new volatility. And of course, we're going to be looking at one of the main events of this afternoon, which of course is the US Core PCE Price Index, which is one of the most watched tools within the global economy. And of course, definitely known to be one of the favorites of the Federal Reserve. So we're definitely going to be looking at this and looking at how that's going to create signals within the market. Before we do go onto the live charts though and look at the live announcement itself, we've still got 18 minutes before the announcement. I want people to get a good understanding of the currency markets in general because we've seen a lot of volatility, especially this week over the past 5 days. We've seen a lot of volatility. So let's look at the currency market, get an understanding in terms of how many interest rate cuts we're likely to see, what is being priced within the market, and of course, how and if that is likely to change going forward. So this is the first thing I want to look at. Then we're going to move on to looking at the Japanese yen specifically, what's going to influence that, and how we are able to predetermine the price movement. Because if we're able to predetermine the price movement, is then where we are able to consecutively succeed as a trader, which is of course what we're looking to do. And then we're going to go to the live chart straight away and look at the live announcement. Now, here, ladies and gentlemen, we've got six currencies. It's the most traded six currencies globally. So we can see we've got the US dollar, we've got the euro, we've got the GBP, we've got the Japanese yen, the Australian dollar, and the New Zealand dollar. And what I've done is I've actually given everybody the performance of these currencies. And in addition to this, on the last column, we've also going to look at interest rates and the future interest rate path. Now, what you will see, ladies and gentlemen, when we look at this, is very simply the only currency which is increasing in value. And before I mention this, I want people to be aware this is based on the currency's performance against the market. So it doesn't necessarily mean people may say to me, the euro is declining, the British pound is declining as well. When we're looking at the euro against the British pound, both can't be declining. Uh, Keep in mind, looking at currency is the one which is going to be benefiting over the other. But of course, this here is the figures based on the performance of the currency against the whole of the market. And this is something extremely important because I always say to traders, when we're looking at the financial trader markets, and especially myself, people know me for a very long time. I've been in the market for 10 years now. Back when I was a financial advisor in London, that's going back now 6 years ago. We always used to say to individuals, when you look at a currency pair, you always look at it not as one single asset, but you look at it as three different assets because you analyze the asset as an exchange rate. So, for example, the Euro USD. But in addition to this, we also analyze it as the euro as an individual currency and the US dollar as an individual currency. So it's like you're analyzing three completely different assets. You analyze the exchange rate, and then you analyze both currencies individually. Now, give people a good understanding. What people want to avoid, and we're going to make this relevant to the Japanese yen particularly, is what they want to avoid is a tug of war scenario. So when you've got, let's say, two currencies pulling against each other with no dominant currency. Because what that basically means, ladies and gentlemen, is there's a higher possibility of there not being a trend formed, or a weaker trend forming, and momentum not necessarily lasting. A lot of the time, when we get that scenario, it's known as a tug of war scenario between two currencies. Tend to get a reverting price condition. Whereas beginner traders and most traders within the market, they want to see a trend, because when there's a trend, most of the price movement is moving in one direction. In that direction is the larger price movement, and it tends to last. So that gives people enough price movement to trade and benefit and profit from. And also, even when you're trading in the small areas of the trend, such as retracements and pullbacks, when the market moves against you, the fact that you've got poor timing in terms of the trade isn't necessarily a massive issue, very simply because you are still trading in the direction of the overall trend. So, for example, we can see here the strongest currency at the moment is, of course, the US dollar. Now, in order to avoid that tug of war scenario, we need to take into consideration how we want to trade the US dollar against what currency. So, what currency pair are we looking at? Now, somebody was going to trade, let's say, for example, the trend, and they were looking at the US dollar, well, should we say the pound against the US dollar, because it's the GBP USD. They would struggle more than if they were trying to take advantage of the US dollar appreciating in value than, for example, the Japanese yen. And this is where we're going to bring the Japanese yen in, and this is where we're going to look at today's major announcement. Because we did get a major announcement this morning. We had the Bank of England's interest rate decision. We also had the Bank of England's monetary policy statement, and also the press conference from the governor of the Bank of Japan, not the Bank of England. So it's about having two currencies which are not colliding against each other. We want clear indication. So, for example, when you've got one currency like the US dollar, and then you've got another currency like the Japanese yen, where one is appreciating against the whole of the market and the other is decreasing against the whole of the market, you are able to trade the trend more efficiently, and analysis is a lot easier. And this is very clear and very basic to understand. People most likely have never thought about it in that way, but it's known as avoiding that tug of war scenario. Now, of course, the US dollar is the best performing. After the US dollar, we've got the pound, then we've got the euro. The worst performing, ladies and gentlemen, if we're going to avoid the Japanese yen, is actually the New Zealand dollar and the Australian dollar. But keep in mind, they've really picked up pace and they've been a better performing currency, especially over the past 2 weeks. This is for fundamental reasons. We also need to take into consideration that the monetary policy stance of the euro and the European Central Bank, as well as the Bank of England, has significantly weakened as well, especially when you're looking at the euro. And simultaneously, because of higher inflation in Australia and because of sticky inflation in New Zealand, so they've really struggled to bring inflation down compared to the other countries here. Because of this, their monetary policy is expected to remain unchanged, at least for the foreseeable future. Whereas if we're looking at the euro, we actually expect the euro to be, and the European Central Bank, to be the first to decrease interest rates. We actually believe that, when I say we, I'm referring to the market, not myself, or not HF markets, but the market in general. It is actually predicted that the European Central Bank will be the first to cut interest rates. When we're looking at the US dollar, the reason why the US dollar is performing so well, ladies and gentlemen, is again very simply because at the very beginning of the year, and if you look at the first 2 months of the year, the US dollar was struggling. In those months, the market was pricing into the market and was predicting that the Federal Reserve will cut on 6 occasions this year, starting from March. Now, if we look at it again, we were before yesterday expecting the Federal Reserve to cut between two to three. On 2 to 3 occasions throughout the second half of the year, more specifically after the summer months. Whereas now, because of the gross domestic product and because of some inflation figures from which are included as part of the gross domestic product, we now actually are amending that prediction to three, so 1 to 3 interest rate cuts. So not 2 to 3. We're slightly weaker now, and I'll actually show you this from the how you can see this from the exchange rate. The central exchange directly. I'll actually show you how you can do so. The market is actually predicting less interest rate cuts and also an even further delayed interest rate cut. We even had some members of very large institutions this morning on Bloomberg who actually said there's now a possibility there's not going to be an interest rate cut as far as December. So we're looking at the very end of the year. Now, this creates a lot of volatility for currencies. Keep in mind, there is a very strong correlation between the Japanese yen and the US dollar as well. This is definitely something people need to take into consideration as well. And we're going to look at this in a moment because when we're looking at the Japanese yen, ladies and gentlemen, we need to take into consideration what is the domino effect of the Japanese yen. Now, what I will mention as part of today's session, today's live analysis, is a lot of the time as investors and as traders, especially when we're looking at institutional traders, when I've worked on trading floors and I've worked with very large companies, the company and the analyst within will always have a bias. So it's about developing that bias. Yes, we have technical analysis, we have fundamental analysis, but while we're looking at the signals and trying to trade the next 15 minutes price movement, or it could be the next 1 hour price movement, at the same time, we are developing a bias for the day. And again, most ideally, what everybody most likely wants to achieve is the signal which is in line with their bias. Now, if you're able to do so, you are able to increase your success rate, in which case you're giving yourself more leeway as well in terms of your reward to risk ratio. I've got some questions. Of course, I'll answer these questions throughout the session. Let's very quickly have a look at the questions. Um, So I've got somebody here who's saying, can we analyze gold? Yes, we will definitely analyze gold. Somebody says, can we analyze the US dollar? Yes, we will, especially against the Japanese yen. We're going to look at the scenario of a Japanese intervention, which is definitely a possibility. We even saw a very, very strong spike downwards today, where obviously a very large player within the market entered the market into the Jap in terms of favoring the Japanese yen, potentially because he or that company is predicting an intervention at some point. I've got another question here. So this question is actually something we're going to look at in a different slide. So I'll wait to answer that question. I've got a last question here. Please, I need to know if we are buying more or selling more. Please clarify in terms of what asset you are referring to. But we're going to go to the charts in a moment, and you're going to get a better understanding in terms of what the indications are, what the signals are, and what potential targets we can look at. What can we trade when pairs are unchanged? You can trade other assets which are not part of the currency category. So, for example, a lot of people that trade gold, a lot of people that trade indices as well as of course individual stocks. We're going to look at individual stocks and earnings as well. So, what's influencing? What is that domino effect of the Japanese yen? When we're looking at the Japanese yen, we have to take into consideration that it is part of a specific category of currencies. And we couldn't even slightly enlarge that category and not refer to solely as currencies as well. There is such a thing as the safe haven category. Now, as part of the safe haven category, we have certain currencies. Definitely, we've got the US dollar, which is one of the number one safe haven currencies. Then we've got the Japanese yen, which is a very well known safe haven currency, even though at the moment that status is slightly depreciating for obvious reasons. We've got some other minor currencies as well, such as the Swiss franc. Some people in certain regions around the world also consider the Australian dollar, even though it's not an officially part of that category for obvious reasons as well. But you've got US dollar, and you've got US bonds, you've also got gold, and so on and so forth. Now, why is the US dollar also being, sorry, why is the Japanese yen also being affected by a weaker US dollar? When we're looking at a category, we have to think about the fact that each of these assets are competing against each other in order to prompt investments from the market, from investors. Now, when the market wants to either mitigate risk or spread their risk and they want to invest a certain percentage of their funds in safe haven assets, then of course they need to determine which one they're going to invest in. Now, if the US dollar is weakening, that really provides an opportunity for the Japanese yen, and not just the Japanese yen in terms of the USD Japanese yen, but the Japanese yen against the whole currency market. So, if the US dollar Japanese yen is decreasing in value, there is a heightened possibility that the Euro JPY, the GBP JPY, the Aussie JPY, and so on and so forth are also going to see a similar price movement. So, weaker dollar, ladies and gentlemen, is positive for the Japanese yen in general against the whole of the market. And again, if we go back to the previous slide, this is the performance of the year. You can, of course, refer to the performance of the day. You can refer to the performance of the month or the performance of the year. You could have referred to all three scenarios. For example, myself, I refer to all three scenarios because I think the more information, the more power I have as a trader. So, for example, we're looking to trade and speculate that the Japanese yen is going to increase in value. Yes, of course, I can do it against the US dollar because there's that scenario there where they're both competing as a safe haven asset, and there's a lot of volatility there for that reason. But I also can take into consideration the currency which is weakening the most. So, for example, I can take into consideration the Aussie dollar, the New Zealand dollar as well. This is, of course, though, based on the year so far performance. You also need to take into consideration the daily and the weekly as well. So, of course, if you want to indicate and speculate that the Japanese yen is going to increase in value, ideally you want to do so against the worst performing currency rather than the best and strongest currency. Then we've got monetary policy adjustments from G10 members. Of course, as the G10 members, also the G7, we can include more or less countries. It's completely up to you. But as their monetary policy weakens, it favors the Japanese yen. And we're going to go to the announcement in a moment as well, ladies and gentlemen. But also something else which supports the Japanese yen is lower US bond yields. If there is a higher risk appetite within the market, which tends to see a weakening of the US dollar, again, it's the same scenario. If inflation declines globally but not in Japan, that's another scenario where the Japanese yen can benefit, and definitely higher Japanese inflation as well. Now, ladies and gentlemen, very quickly, let's go to the announcement. So we've got a calendar, ladies and gentlemen, which you can take advantage of. So, for example, if you very simply type in HFM calendar, should we say, like this, and we go to today, we go to filters, I go to none, And then I'll just go on the United States of America because, of course, we want to look at the Core PCE Price Index and its results. And the announcement is going to take place any moment now, ladies and gentlemen. Now, the announcement is expected to show 0.3%. Now, if that comes in higher than expected, everybody should expect a lot of volatility in the stock market. So, we're looking at individual stocks, we're looking at indices as well. So, if we see higher inflation, ladies and gentlemen, the possibility of interest rate adjustments and interest rate cuts are really thinning and really declining, ladies and gentlemen. So we have to take that into consideration. Whereas if we get lower inflation data, then of course it's bringing back that scenario that inflation is under control. There is still on the table the possibility of interest rate cuts, even if it's going to be a delayed interest rate cut. It may not be in June and July like previously thought, but even so, there still is a possibility of 2 to 3 interest rate cuts in 2024. I've got a question here very quickly. I'll answer it. So somebody is asking, what about if it comes in as expected? If it comes in as expected, there's still a possibility that it can support the stock market. So, for example, the Nasdaq. Let's very quickly refresh so we can see the announcement. Let's again go to today, filter, remove. Let's go to the US and let's look at the announcement. Right, here we go, ladies and gentlemen. So we've got the core inflation data for the month came in at 0.3. 0.3, ladies and gentlemen, is as expected. So it does have the possibility there to support the stock market because it's not more than what was previously expected. However, ladies and gentlemen, people also can look at the yearly data, not just the monthly data. Now, if we look at the yearly data, the core personal consumption expenditure index is actually saw it's higher than expected. So it's remained unchanged. It was expected to decline, but it's remained unchanged. Now, that, ladies and gentlemen, technically is negative. Now, if we're looking at earnings data, ladies and gentlemen, because this is something which is really going to drive the market, we have to take into consideration uh, when we're looking at the Nasdaq. We'll start off with the Nasdaq, and then we'll look at gold. We'll look at the Japanese yen, and we'll look at the US dollar. When we look at the Nasdaq, we have to take into consideration what is the most influential stocks because it's a weighted index. So some stocks are more influential than other stocks, very simply. Now, if you go here, ladies and gentlemen, to this website, okay, what you can see here is it ranks the companies. Now, where it ranks the companies, it gives you the companies which are the most influential. So, for example, if we look at here the most influential, we can see portfolio percentage. So, what percentage of the Nasdaq? What percentage of the Nasdaq is actually being made up of Microsoft stocks? So you can see almost 9% is being made up of Microsoft stocks. If we look at that, the second and the third and the fourth most influential, what you will notice is that actually, if you look at Alphabet, Alphabet has, excuse me, Alphabet has two stocks. Alphabet has the stock class A, stock class B, stock class C. Now, two of those stocks are within the index. Now, if you add these two together, we're looking at more than 5%. So actually, Alphabet is the fourth most influential stock. Now, Alphabet released their earnings yesterday, ladies and gentlemen. If we look at Alphabet's earnings, their earnings, if we compare it to the previous quarter it came in at 1.64 in terms of the earnings per share. If we look at, ladies and gentlemen, the revenue came out. It came out at $68 billion. Now, if we look at this quarter, the earnings have significantly increased. And not only have they significantly increased, they were 25% higher than previously expected. When we're looking at revenue, we're 2% higher than previously expected. Now, because of this reason, you can see here that Alphabet stock in the pre-market hours is trading almost at 12% higher. 12% higher, ladies and gentlemen. So significantly higher. Now, if we look at Microsoft earnings, if we go back here, keep in mind Microsoft is the most influential. If we look at Microsoft, again, it's 4% higher before market open, so a lot of volatility, ladies and gentlemen. We got just over 3% higher than expected, just over 1.5% higher than expected in terms of revenue. So here you can really see that there is positive factors in terms of what's driving the stock market. Now, the other thing people also take into consideration when trading is they look at the most influential stocks. And when they're trading, they want 75% of those stocks to be trading in the direction of their signal. So, for example, if they want to speculate that the price of the Nasdaq is going to increase in value, they will look at the most influential stocks and say, I need 75% of those stocks to be increasing in value for it to coincide with the signal. So what they're doing is trying to lower the risk of their analysis being incorrect and opening a trade which is actually going to move against them, or should we say against the trend. Maybe the trade may move against them temporarily, but what they want is to avoid a completely different trend. So there's different things people look at. Now, some people look at the top 10 most influential stocks because they don't want to be looking at too many stocks. Some people look at the top 20. The main rule within the market, which is very well known, is they look at all stocks above 1%. Now, all stocks above 1%, we're looking at 25 stocks. So how many stocks, let's say for example, we'll get a calculator as well. So we can do this together so everybody can see exactly how I'm doing this. Here we go. So how many stocks have we got from the 25 stocks? Because we're looking at all stocks above 1%. How many of those stocks are increasing in value? So we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 stocks. So 12 stocks from 25 increasing in value. So we've got less than 50, ladies and gentlemen. I don't need to use the calculator. There's less than 50. Now, in order to be able to get a clear indication from the components of the Nasdaq that is going to increase or decrease in value, we need at least 75%. Now, people can slightly amend this. This is based on this very well known tool. Some people may say, I want slightly more trades. I want to be more active within the market, and I'm going to lower that requirement and say I want 70% to be increasing in value, or 65%. Some people may have a lower risk appetite and don't want to risk and would rather wait for a stronger signal, in which case they say, I don't want 75%, I want 80%. That's absolutely fine as well. But what they want to see is that those stocks, based on this tool, 75% are increasing in value. What I will say, if somebody's following the top 10 most influential here, we have from the top 10 most influential 80% increasing in value. 80% increase in value. And also the most volatile is definitely Microsoft and definitely Alphabet, which are significantly increasing in value. So it's 80% increase in value. The most volatile is increasing in value as well, seeing bullish markets conditions. But ideally, we want slightly more increases, especially from areas of the market such as here. So it is up to you as individuals if you want to look at the top 10 or if you want to look at the top 25 on this scenario, because it's 25, which is above 1% holding of the portfolio. But again, we're going to revisit this. This is something people have on their screen, and while they're trading and while they're analyzing, they refer back to this again and again. Now, the other thing people need to take into consideration is bond yields. If bond yields are declining at the moment they're declining as well, it supports a bias that the stock market is going to increase in value. If it starts to increase in value, if bond yields start to increase, then it indicates the stock market is going to decline. Now, some people may, should we say to themselves, why is when bond yields increase in value, why is it negatively affecting the stock market? Very simply, when bond yields increase in value, everybody's debt becomes more expensive. So your mortgage, your rent, your credit card. So if we've got somebody who's maybe thinking about whether he wants a fixed term mortgage or a tracker rate or capped rate mortgage, whatever it may be, maybe he also wants to look at the bond yields for different reasons. Because when bond yields increase in value, everybody's debt becomes more expensive. When people's debt becomes more expensive, of course, you spend less, in which case these companies perform worse, in which case, for obvious reason, there's less demand for stocks and the stock market. Let's look at the US dollar. US dollar slightly higher, ladies and gentlemen, which at the moment is not necessarily high enough, I would say, to necessarily instantly, imminently pressure the stock market. But ideally, we would like to see a lower US dollar. And actually, as I said, that actually declined as well slightly. It was at 0.10, fell down to 0.6. And the last thing I want to people to look at is the FedWatch tool. So this is the CME FedWatch tool. This is the exchange itself directly, and it gives people the indication of when there's likely to be an interest rate cut. So, for example, in May, so next month, there is no scenario where individuals are voting that there's going to be an interest rate cut. No scenario. This is the current interest rate, 99%. If we go back a couple of months ago, this was at less than 40%. So you can see a very big difference there. If we look at June, there's only a 12% possibility of a cut. If we're looking at July, 31%. So the main possibility of a cut is actually in September. Now, some people may say, I understand interest rates, it affects the stock market significantly, but how do I use this? Ladies and gentlemen, what we're trying to do is, before we start looking at technical analysis, to build a bias within the market so that we are lowering the risk of misanalyzing the charts, because we're going to look at the charts now. We want to lower the risk of misanalyzing the charts. Now, we look at this because as the chances of an interest rate cut increases, and you'll be able to see this. So, for example, this becomes 50 or 55 or 60. And if we look at June, for example, it's not 11%. Again, you can see this has changed, by the way. Just over the last couple of seconds, it was almost 13%, now 11. As that decreases, it pressures the stock market. So if there's a lower possibility of interest rate cuts, it pressures the stock market. If it's higher possibility of a cut, it supports the stock market. So how can we build a bias? Ideally, first things first, we want 75% of the stocks here to be increasing in value. At the moment, we're only able to obtain that 75% required if we look at the top 10 or if we look at the top 15. If we don't, we're unable to satisfy that requirement. And again, like I said, there is some people that look at the top 10, top 15. I've mentioned above 1% because it's a very well-known tool. But of course, you can use a different approach. In addition to that, we want bond yields lower. They're currently lower, even though they're slightly rising, I can see now. Again, which can pressure the stock market. US dollar, if the US dollar is weaker, again, it's better for the stock market. If it's stronger, it's better for the stock. It's worse for the stock market. And again, here we ideally want to see higher possibility of interest rate cuts. Now, ideally, we want all four to point in the same direction. At the moment, we don't have all four pointed in the same direction. Why? Because the US dollar is more expensive. There's a higher possibility that the Fed's not going to cut, which is actually indicating pressure on the stock market. If we're looking at bond yields, they're lower today, which is positive for the stock market, but they've increased in value. And you can see here it was down here, but it's increased in value over the past few minutes. And bond yield, and sorry, the stock components, if you're looking at 15, top 15 influential, top 10 influential, they are indicating upward price movement. So it's actually conflicting. So what it's actually indicating, ladies and gentlemen, is that we may be going to see a reverting price condition within the market. So if we go and look at the charts now, this is that we'll look at others as well. I do promise that we will look at other assets. Here you can see as soon as the announcement. Let's actually go for to the 1 minute just for to look at the announcement. This actually is showing you exactly what I pointed out. Like I said, there's scenarios where yes, it supports a price increase, but the scenarios where it actually supports the price decrease in value. So I said, it's that mixed signals where we don't want. We want signals in one direction. As traders of CFDs, we don't care if it's increasing or decreasing. We can benefit from the both directions, but we want the signals to indicate the same direction. Like I mentioned, even before we put this chart up, and I looked at it, we aren't seeing indications of the same direction. Uh, and we can see that massively helped us if we were trading because we saw a significant increase in value. As soon as the announcement was made, ladies and gentlemen, the price increased in value by 0.6, almost 0.60% in just 1 minute. But what happened? As soon as that happened, ladies and gentlemen, the price declined to that previous price range. So we can really see that, ladies and gentlemen, and how that building that bias for the day significantly supported and assisted us. But some people may say, how am I going to trade this though? How can we get an indication now in regards to that? Well, the first thing is we start off with the 2 hour time frame. We've got a very well-known setup here, ladies and gentlemen. We have the 75 bar exponential moving average. I'll bring this up on the chart so you can see. So moving average, 75 is the period, exponential is the method. Now, if the price is below, like this here, it indicates sellers are controlling the market. If the price is up, down, as it is and has been over the past 3 days, then it indicates a reverting price condition. We mentioned the reverting price condition as well, even before we looked at the chart, because of those mixed signals. Whereas if you're looking at the RSI, ladies and gentlemen, the RSI, if it's below, like we saw here and like we saw here, um, indicates that sellers are controlling. If it's above, it indicates buyers are controlling the market. Now, at the moment, we are getting indication of a reverting price condition. So, yes, we're seeing higher highs. We're seeing higher lows as well. We're above the 75 bar exponential moving average, and we're above the neutral. We're above the 50 on the RSI as well. We're currently at 58. So it's a healthy area of the market. So that indicates the price is going to increase. But ladies and gentlemen, if we look at the price here, the price actually moved on slightly higher. But if we look at the RSI didn't cross slightly higher. It was actually lower. So there's a very weak divergence signal there. It's not quite divergence yet, but it's in danger of developing divergence. Developing divergence is going to indicate that the price is going to decline. It won't confirm to us if it's going to be a retracement or a stronger decline, but either way, it indicates a decline. In addition to this, ladies and gentlemen, as well, we can very clearly see we were unable to significantly break above the previous high. Now, what can people do in order to obtain a signal? People have two options. They can look at the breakout level. This is the breakout level here, ladies and gentlemen. If it breaks above this level, then you continue to speculate the increase. Now, this is option number one. It's a very simple option, but it's slightly less effective and you enter into less trades. Now, why do I say that? Because when you look at the breakout, ladies and gentlemen, so for example, here when it was downward trend, this is the breakout. If you traded after the breakout, you would have been successful. The price did move in your favor. But above it, there's 1% price movement, which you avoided trading. So you could have entered earlier and traded and made up more of the price movement. Whereas, the trend, that impulse wave, it ends here. It started here, and you've missed. So you can see here, you've missed half of it. Let's look at the next wave as well, or even this last important wave. So the breakout levels here, okay? There's nothing after the breakout for you to be trading. So if you're trading at the breakout, unless you are a scalper and we're trading very quick, just trying to earn a small profit and exit, there's nothing wrong with that. Um, you would have struggled a lot because this is the breakout. As soon as it broke out, the trend changed. What you can do is when it retraces, you draw a Fibonacci level like this. So instead of trading at the breakout's at this 100 here, ladies and gentlemen. Instead of trading at the breakout, the 100 level, you could trade at the 61.8, which is this level here. Now, if you're trading at 61.8, you can see you're trading earlier and you've got a better opportunity to benefit and profit from the price movement. So based on the higher and earlier entry at the 61.8, you're profiting 1.24%. So there's a very big difference between 1.24% and a difference between that and 0.39. Very, very big difference, ladies and gentlemen. So this is something you can take into consideration. So we can see it's retraced, but we're above the 75 bar exponential. We're also above we're also above the oscillator as well, the RSI. What you can do is this is the high, this is the low. As soon as it breaks above the 61.8 again, okay, we will also do this method on a smaller time frame. As soon as it breaks above the 61.8 again, which is at this level here, at this red line, you can then start to speculate the price increase. So what you're basically saying is, yes, I can see the trend line and the oscillator is indicating a price increase, but I want to see more momentum upwards to re-establish that before trading. And the only concern at the moment, ladies and gentlemen, in regards to that is the fact that we've got a slight divergence here. But again, if we get that much momentum upwards again, maybe that divergence will start to fade. What can we do as well, in addition to this, is we can look at the same asset and look to do the same thing on the Fibonacci level, ladies and gentlemen. So you can see here, I'm drawing the price rejection level here, starting the Fibonacci there, taking it all the way down to the low as well, because we're close to the low, and I want it to break above the 61.8. What you will notice is the 61.8 is really at a significant resistant level as well. Very important resistant level. So again, if it breaks above that, you can trade and speculate potentially that upward price movement. The only concern again is that we can see that divergence on the stochastic oscillator as well. The stochastic oscillator very clearly here is weakening. So, ladies and gentlemen, we want to see, of course, how that develops. The market isn't open yet in the United States. As the market opens in the United States, we're going to get a better idea as to whether we're going to see an upward or downward trend. We keep looking at this, ladies and gentlemen, to see if that scenario changes. At the moment, we're just about in that 75. Somebody says to me, what if you look at the top 20 rather than everything above 1%? Oh, of course, that's something that you can look at. So if you look at top 20, how many are in red? We've got 1, 2, 3, 4, 5, 6, 7, 8 in red. So if we do 8 over 20, 40. So if we're looking at top 20 stocks individually within the NASDAQ, 60 are increasing, 40 are decreasing. So again, we don't have at the moment an indication here that the price is going to increase. If we're looking at the bond market, the bond yields are lower. Again, like I said, that's positive for the stock market, but it's higher than it previously was. So that's not reassuring us in any way, shape, or form. If we look at the US dollar index is still higher. So again, the scenarios there, ladies and gentlemen, which is indicating that the stock market actually potentially may become pressured. Now, we've got indications, like I said, of price increases and indications of price decreases. A lot of the time when we look at live analysis, especially as part of our webinars, in which case you have to register for them, we most of the time see scenarios where all indications point in the same direction. This is something we were seeing for a very long time on the Nasdaq as the price was declining. At the moment today, though, it's a mixed scenario. So it's actually continuing that pattern that we have been seeing of a reverting price movement. Reverting price movement, if we're looking at, for example, let's say all price movement from this week. So we're looking at basically 35 bars. So if we go 35 bars like this, sorry, over the past 3 days, not this week, uh, this is that reverting price here. Okay, so that's the most important price here, ladies and gentlemen. So at the moment, we've got still scenarios for that. So let's start looking at gold as well. I promised that we would look at gold. Let's go back to 75 and we can look at what type of indications we're having for gold. The first thing I will mention, ladies and gentlemen, is the US dollar is slightly more expensive. Now, if we're looking at gold, we've gone back to that 75 bar exponential moving average. We can see that's a very significant level. So you can see each time. So for example, here, we saw that each time it gets to that 75 bar, we tend to see somewhere around that level. It's not always accurate, but somewhere around that level, we tend to see either support or resistance. Now, at the moment, we're below and we've gone above slightly, but again, we found resistance at that level. Now, here at the moment, we have slightly conflicting signals. Whereas when we were looking at the Nasdaq, we didn't really see conflict in terms of the trend line and the oscillator. Here we can though. If we're looking at the oscillator is at 57. That indicates buyers are controlling. Whereas if we're looking at if we're looking at trend line, we're actually slightly below. Now it's only slightly. So again, we've not really got a clear indication here, ladies and gentlemen. But what I will say is, where are we likely to get a clear indication? Now, we ideally want enough price movement in order to trip this RSI below the 50. If we get enough momentum where the RSI drops below the 50s, at that point, we're definitely going to be below the 75 bar and below the RSI as well. So there, we can start to speculate that the price will again start to decline. Most recent scenario where we saw that is we can see the RSI drop below 50 here, but it dropped below the 75 by exponential here, ladies and gentlemen. So that's the most recent scenario where both were lower. Okay, you can see though, after that, where we got a very clear indication there, the price of gold declined by more than 3.5%. So a lot of price movement, ladies and gentlemen. But that's what we want to see. We want to see clear signals. Now, if somebody says, I believe gold's going to increase in value, it's a possibility, of course. But ideally, even yes, with the RSI is in a good area, but ideally we want the price to be above the 75 bar as well. So what we can do is, again, we go to the 5 minute, we look at the retracement and draw our Fibonacci level. So scenario number one, if we want to speculate the upward price movement, we can trade at this level here and wait for the breakout. Scenario number two, okay, this is the retracement here. Now, you've got two options in terms of the retracement. You can look at this retracement like this, in which case you will say, I want the price to trade above the 61.8 here. So if the price increases above there, it's enough price movement for me to say that, yes, the price is going to increase upwards. So this is scenario number one. Scenario number two, though, is we look at the larger retracement, in which case the price is here, in which case it takes our buy entry slightly further away. So for example, here. So this is something that you can also take into consideration as well. Now, ladies and gentlemen, do we have anybody that has any questions? We looked at gold and we've also looked at NASDAQ. If anybody has any other questions, feel free to ask. Somebody says if we can look at the US dollar against Japanese yen, we'll look at it on the same setup. We won't change setup just for this session at least. So let's go to USD, JPY. There we go. If you look at the USD JPY, we can see the US dollar significantly increasing in value again. Found support at that 2 hour chart. At that 75 bar exponential moving average on the 2 hour chart. Very, very clear indications here, ladies and gentlemen, that the price is going to continue its upward price movement. The only thing I will say is definitely overbought. It's extremely high. It's the highest that we have seen in a very long time. We're going back to the 90s and 80s since the last time we saw such a high price movement. It's increased in value for 4 consecutive weeks, ladies and gentlemen. It's the highest that we have seen in recent years. So the possibility now of an intervention from the federal government of Japan is significantly high. So, of course, if we do get an intervention, a lot of the time what we do see is a very strong spike downwards. As stated as part of this morning's market analysis blog, that is not a strong possibility of them intervening before the PCE price index. We've been saying that for a couple of days now. But next week, there is a heightened possibility of an intervention now that we can see that the US dollar is increasing in value and that we can also see that we are at a very high level on the RSI, a very high level in terms of the exchange pricing. If you have any other questions, ladies and gentlemen, feel free to ask now. So I've got somebody here who says, what stock has the most competitive price to earnings ratio? I'm not sure in terms of the whole stock market because we're talking about thousands of stocks. But I do know from the Magnificent Seven technology companies, it's known within the market as the Magnificent Seven. So basically, Alphabet, Google, Apple, Nvidia, Meta, and so on and so forth. I won't go through all seven. I know that actually Alphabet has the most beneficial price to earnings ratio. Now, what does that mean? That means it's got the lowest price to earnings ratio, which basically means the price which you're paying for the stock compared to how much their earnings is low. So, for example, like saying, we've got this account where you have to pay 1,000, and in return it will give you $10 per month. And we also have this account which is 1,000 again, but it gives you $20 per month. The price to earnings of the second account, which pays you more, is better, okay, because it's lower. So the same scenario is basically for the price to earnings ratio and for Alphabet. Alphabet at the moment has the lowest price compared to its earnings. So it's basically indicating that it has the most competitive pricing and, should we say, the highest possibility of potentially trading below its intrinsic value. So hopefully that answers your question. Again, I don't really know for the whole stock market because by the way that he's written it's like he's referring to the whole stock market. I'm not sure, but for the 7 most influential technology companies, it is Alphabet. What happened to the USD Swiss franc? He also says, I lost some funds just now. What I will say is, when you're trading, you have to think of it as a business. Whenever we have a business, like for example, when I was a financial advisor in London and we used to look at accounts, we used to look at business, and a business will always have turnover, so money being brought in, and expenses. When you're trading, your profit and loss should be viewed as turnover and expenses. And a company will always have expenses. So a loss isn't necessarily negative, it's part of your business and it's part of trading. The important thing, though, is that your reward to risk ratio of your trading, okay, so how much you're looking to earn compared to how much you're looking to risk, is in line with your success rate. So every single week, you should look at your success rate and say, okay, I've got a high success rate. It could be 90%. So I can, for example, have slightly less competitive reward to risk ratio. I have that benefit. Whereas if you've got a low success rate, some people maybe that are new to the market and it's at 30% or 40%, they know to themselves that I need a high reward to risk ratio to still be profitable. Because even though you have a low success rate, you can tweak your reward to risk ratio to ensure that you're still profitable. So let's go to the US dollar against Swiss franc. Oh, somebody requested it. I've lost it now. There we go. So if we look at the US dollar against Swiss franc, let's go to the 2 hour time frame. So at the moment, again, we're at that neutral level, okay? I wish I could give you a clear indication, but here at the moment, you can see we're at that neutral level. We're not in an area like, for example, here or for example, here. We're really at a neutral level here. And also keep in mind, here, we've got a lot of volatility and we've got directions, multiple volatility in different directions. There's benefits to looking at an exchange which has a clearer direction. So this is why I said previously, we look at the currency exchange as three assets. We look at the US dollar, we look at the Swiss franc, and we also look at the US dollar against the Swiss franc. Now, we're looking at this multi-direction volatility, which makes it slightly harder for a beginner to trade. Um, because we have two currencies which are both increasing in value a lot of the time. So there's that conflict, there's that tug of war scenario. Whereas if we compare this chart and then look at, for example, the US dollar against Japanese yen, we can very clearly see it's a lot easier to be trading this. And also the spread we can see here is also significantly lower as well. But nonetheless, let's look at this. The bias at the moment, ladies and gentlemen, is at that neutral. At the moment, we don't have a clear bias. Very, very clearly because we're only just above the 75 bar. So it's not clearly above or clearly below. And we're exactly at that neutral on the RSI as well. The RSI, you can see, is pointing down. It's got lower lows, lower highs. So it's giving a bearish bias, should we say? Whereas if we're looking at the 75 bar, we're above the 75 bar. So it's actually giving a bullish bias. So technical analysis doesn't significantly help us at the moment for the US dollar against the Swiss franc. Now, if we get significant breakouts, so for example, if we get a breakout of here, or we can use a slightly higher breakout here, or we get a breakout of here, then that's a possibility that you can break. Where as it breaks out, you can use that to speculate accordingly. Any other question, ladies and gentlemen? Otherwise, we'll end the session there. Okay, so I can't see any other questions. So let's end the session. Enjoy the rest of your Friday and evening and weekend, of course. Always, as I always say, trade safe, trade responsibly. Hopefully, you found today's session educational. Somebody very quickly said, please, very quickly, can we look at that? The euro against the US dollar. Of course, I can. Bear with me. Let's get it up on my screen. Euro, GBP. Sorry, he mentioned the euro against the British pound, not US dollar. Here we go. Now, this is an indication, ladies and gentlemen, that the price is going to decline. So you can again see here the difference between this and the previous chart. So here we can see we're below the 75 bar, we're below the neutral on the RSI as well. Now, it doesn't mean because we have an indication here that it's going to decline, we should instantly go and place a decline. We switch onto a smaller time frame like this, and we wait for more volatility in that direction. So, and again, there's a couple of scenarios that we can take into consideration. We can look at this breakout, we can look at this breakout here. Alternatively, like I said, if we want to trade slightly before the breakout, we can put our Fibonacci levels here. So, for example, if it declines below this level, then we trade and speculate in favor of the euro against British pound. So, hopefully that assists. Let's end the session there. Enjoy, ladies and gentlemen. Hopefully, you found today's session informative and educational. And hopefully, we'll see you very, very soon on our next session. In the meantime, remember, everybody, that we have copy trading. We have as well also swap free accounts. We have ultra low spread accounts as well. So we try and provide as much tools, products, conditions, and educational material as possible in order for you to be active within the financial trading markets with confidence and knowledge. Somebody says, can we look at gold? If you go back onto the webinar, you will be able to see that we looked at gold for approximately 10 minutes. On the 2 hour as well, very quickly, again, we can see we're at that neutral level, that neutral line here, with a slight bias of gold increasing in value because we're slightly above, and we're also above on the RSI as well. So let's end the session there. Enjoy, ladies and gentlemen, and enjoy your weekend. Goodbye.